Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. The Reserve Bank Board yesterday left the official cash rate on hold at 4.1%, with Governor Philip Lowe saying the higher rates are working to establish a more sustainable balance between supply and demand in the economy and will continue to do so. But he warned that more increases might still be needed to get inflation back into its target range, or at least the Reserve Bank's target range. Carlos Cacho is the Chief Economist at Jarden Australia. Carlos, welcome back to Fear and Greed.
Thanks for having me, Sean. Good to be back.
So the big question, do you think the rate rise cycle is over or not?
Look, in our view, there's still the risk is we do see more rate hikes. Inflation, while it is slowing, is still twice the top of the RBA's target. We are still seeing services inflation, particularly in things like rents, insurance, utilities, increasing at a pretty rapid pace. And that's going to make it difficult for the RBA to say anytime soon they're done hiking rates with a sense of certainty. On top of that, we also know the housing market is now picking up again, miraculously in the face of a over 30% fall in how much money people can borrow. And so that creates upside risks to the consumer that the RBA also has to factor into their thinking.
So the bank talked about the services inflation yesterday, didn't they? I mean, clearly it's something that is top of mind to them.
Yeah, absolutely. And this is really a global trend we've seen where goods inflation, particularly in discretionary consumer goods, is coming back as global supply chains ease, as retailers start discounting again, as consumers, make it a little bit more difficult to get into their wallets. And what's left running and has been quite persistent globally is that services component. In Australia, the big driver at the moment is rents, which are accelerating towards about 10% year on year, which is the fastest pace we've seen in a very long time. And that's the second biggest weight in the CPI basket. So that has a pretty material impact on the headline inflation number.
The Reserve Bank is famous for what they call jawboning, talking up or down rates, depending on the economic circumstances, whilst actually not always doing something. Now, the last couple of meetings have been on pause, but we keep hearing the same commentary, but rates may need to rise. How much of jawboning is going on at the moment, do you reckon?
Look, they're going to keep this commentary that the rates may need to rise. They're going to keep their hawkish bias or their tightening bias for quite some time, in our view. As long as there's still upside risk to inflation, which I think is probably going to drag on for quite a few months, if not, well into 2024, they're going to maintain that guidance, because as soon as they stop saying that, then the assumption people and the market are going to have is that rate cuts are coming soon. And so they don't want that, because that would then lead to a loosening in financial conditions and, potentially a pickup in confidence and activity ahead of rate cuts actually being delivered. So they will hold that for a while. That said, their tone was a little bit more cautious this meeting, and we did see the Aussie dollar soften a little bit yesterday, and we saw bond yields a little bit lower and equities a bit higher. So that suggests it was a little bit more dovish, as we say, or a little bit more cautious than what the market was expecting going in.
The other thing, Carlos Cacho from Jarden Australia, is have they changed their forecast on inflation? Because they said that it will be back in the 2 to 3% range, or it won't be back in that until late 2025. I think previously they were mid-25.
Yeah, look, they didn't really change their forecast much at all this meeting. We'll get the full suite of numbers on Friday when they release their quarterly forecasts. But what we saw today is they still expect inflation to moderate to about 3.25% by the end of next year, which is consistent with what their forecast was in May. And they've extended their forecast profile out an extra 6 months to the end of 2025. And they now expect inflation to be within the 2 to 3% band. So it doesn't really look like there's been any change in their actual forecast, aside from just extending the term. And their final forecast was 3% in June 2025. So the natural assumption would be, the second half of 2025, it's going to be below 3%. So it's not really telling us anything new, which in itself is a little bit surprising, given the CPI outcome from the quarterly data we got last week was actually softer than they and the market expected. And so I think that really highlights the upside risk they still see to services inflation, as well as the fact that they are still, likely to maintain this hiking or tightening bias for some time, given their caution around that.
Stay with me, Carlos. We'll be back in a minute. I'm speaking to Carlos Cacho, Chief Economist at Jarden Australia. What about the labour market? It remains very strong. How much do you think that's playing into the Reserve Bank's thinking at the moment?
Oh, that's definitely a big challenge for the Reserve Bank's thinking. We know that wages are picking up now. We're still yet to see the impact of things like the large minimum wage increase in the CPI data, and unemployment is holding at a 50-year low. The leading indicators, things like job ads, are softening a little bit, but they still remain very strong versus history. So the RBA is probably hoping that they can deliver a moderation in inflation while keeping unemployment relatively low versus history. And we'll just have to wait to see how that pans out. But the risk is, with a really tight labour market still persisting, you could get higher wages growth, and that's going to put more pressure on services inflation, which is exactly what they're worried about. Now, the other hard thing for the RBA is productivity just isn't there. And without productivity growth, that means that the cost, unit labour costs, which is basically the cost of labour for producing a standard unit of output, are rising at a record level. And so that's putting upward pressure on inflation as well. So the RBA likes to say that wages are consistent with the CPI target if productivity increases back towards where it was pre-COVID. The problem is productivity isn't increasing to anywhere near where it is pre-COVID, and it's actually deeply negative at the moment.
I want to also ask you about house prices, because the CoreLogic figures came out yesterday in terms of July. House prices are still rising, and if you take Sydney as the leading market, just in terms of leading the market, the heat does seem to have come out of it just a little bit.
Yeah, look, we've definitely seen a moderation in the strength of the housing market over the last couple of months. May and June, auction clearance rates were in the 70s. They're back down to the mid-60s again. The pace of monthly price growth has moderated over 50% from where it was. We were seeing 1% plus outcomes. We're now back below 1%. It's still surprisingly resilient in the face of higher rates. Our expectation remains that rates are going to remain high for longer than expected, and that is eventually going to take the wind out of the sails of the housing market. But that's crucially going to depend on more supply coming on. One of the biggest drivers at the moment is just that there's so little stock on the market. So even though demand might be relatively soft versus normal conditions, there's so few houses available that people are still having to bid up to win them. What we are starting to see now, though, is the kind of unusual seasonal pattern where listings are already starting to rise. And in particular, they're starting to rise for units and ex-investment properties. So we're actually seeing the highest share of investor sales in Sydney in particular on record. About 40% of listings in June and July were in former investment properties. And we think that supply coming online could potentially drive a bit more of a softening in the housing market late this year and into early next year.
Okay, bringing all this together, interest rates, inflation, employment, housing market, do you think that the Australian economy can land over the next 12 months without going into recession, the so-called soft landing? It would be quite a feat. Well, I think 6 months ago we would have said it would be quite a feat. Maybe we won't say that now. But where do you think we are? How do you think we'll be in the next 12 months?
Look, a recession is a risk. It always is. It's never been our base case, though. And I think, when I look at the economy as a whole, there are pockets that are in pain. Discretionary consumer spending is clearly under pressure. But if we look broader than that, if we look at things like business investment, exports, the construction sector, is still doing very well. Yes, residential construction will come off next year, but excluding residential construction, there's still a massive pipeline of both public and private work to be done. And just government spending, as much as the government is showing restraint in not spending this big $20 billion kind of surplus that they're building up, in the face of cost of living pressures, there's still a lot of spending going out the doors. And so I think in the end, we probably will avoid a recession, but that probably means rates are going to remain higher for longer. And I think this is the key thing people need to start thinking about. It's no longer about where the peak is going to be for rates. There might be one or two more hikes to come. There might not. But in our view, I think the more important factor is going to be how long do we stay at these levels? And we expect we're going to remain at the current cash rate or higher until at least the end of next year. So we think it could be quite a while before we get relief of rate cuts coming through, particularly if the economy remains surprisingly resilient.
And Carlos, I can't let you go without asking about the bank side, because I know you're the banks analyst at Jarden Australia as well. Just with earnings season coming up, the big three, or three of the big four, don't actually report. They're on a different cycle, but the Commonwealth Bank does report. What sort of this earnings season, I suppose I'm referring really to Commonwealth Bank, what's the sort of stuff you're looking for from reporting season?
Look, really the two key things that the market's going to be focusing on is, first of all, margins and how bad the fall in margins is. The market is kind of hoping, I think, for a bit of a moderation, things being less bad there than they were in the third quarter. And the other thing will be if there's any signs of bad debts picking up. And there we expect that things are going to remain pretty benign. In a lot of the research we do looking across the economy, across businesses, we really struggle to see much in the way of red flags for rising bad debts or kind of business stress or household stress from the banks. People are under pressure, yes, but it's not yet leading to loan arrears or defaults. And we got another important piece of data out on that actually yesterday with Credit Corp, who's a debt collector, reporting and actually saying that lack of pain on the credit side is actually it's bad for them. They're not seeing as much debt come through to them to collect as they would normally expect in this kind of environment. So I think if we do get a soft landing, that's going to end up being a positive for the banks.
Carlos, thank you for talking to Fear and Greed.
Thanks for having me, Sean.
That was Carlos Cacho, Chief Economist at Jarden Australia. This is the Fear and Greed business interview. Remember, this is general information only, and you should seek professional advice before making any investment decision. Join us every morning for the full episode of Fear and Greed, Australia's best business podcast. I'm Sean Aylmer. Enjoy your day.